Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, as the market heats up, choosing the right investment vehicle becomes crucial to balance the risk and reward. And for most investors, hybrid funds can do the job well. But there are 7 different categories of hybrid funds. So which one do you choose for your portfolio? That's what we'll discuss today with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So let's begin this conversation with, first of all, why hybrid funds? Why not equity to begin with?
Why hybrid is a big question. Most investors know that, there are equity fund and there are fixed income fund, and they are the dominant, fund category. But the point is, the case for hybrid is that they help you balance. Most people get carried away in a roaring market, like when the going is good, everybody thinks that there is no risk. And everybody is chasing recent past performance. And when it is in bad times, people just run away from the market. They think it is way too risky. And these hybrid funds not only help you navigate this kind of, they provide you stability and growth with, growth with reasonable stability, which is the objective for your long-term investment. Not only that, they help you capitalize on this madness of the market, which creates an opportunity. Every time the market goes down, ideally you should be investing more into equity, but it is very hard to do it. The way to systematically do is hybrid, because these hybrid funds decide on an asset allocation, equity, debt, and then they rebalance it, and you don't have to worry about it. So the reason why they are a great vehicle for most investors is that they are simple, they provide you greater stability, they are very tax efficient.
Now, there are 7 different categories of hybrids. Let's focus today's discussion on the balanced advantage funds, aggressive hybrids, and multi-asset funds. Can you draw a comparative analysis of these? How are they different from each other?
Aggressive hybrids are, they are almost like an equity fund, 75% equity. So that is why they are almost like an equity fund, and 25% into fixed income. The advantage of this is that, this frozen asset allocation forces them to rebalance. Equity goes up and they take profits, or they realign it downwards. So they are booking profits continually, and it's a very tax efficient vehicle. So think of it like an investor who is not used to equity. For him, it is a very suited vehicle, because you are participating in equity and it does not give you the massive blow, which is very unnerving for any investor who is getting started. Second one is the balanced advantage. This I would like to give you some background that why it got created. What was the advantage? And it is, today it has become a different animal altogether. Our tax laws have been evolving, and initially a balanced fund was 50% equity, 50% debt. Then our tax law said that it should be it should be dominantly equity, so it was 51% equity and 49% debt, which was fine. Then our tax laws got revised to 65% equity for it to qualify as an equity fund. And that is when some of these balanced funds, or the balanced fund investors, they wanted 50-50. But how to have 50-50 while actually taking the equity exposure of 65% technically? And that is when this balanced advantage came about. Many of these funds were created because they started having something like, the arbitrage position to the extent of 15-20%. So they will have 50% equity, 30% debt, and 20% into arbitrage, which the character of it will be fixed income. But from a tax point of view, it will be treated as fixed income, treated as equity. So it was able to alter a 20% allocation to fixed income kind of thing into equity, and that is how balanced advantage got created.
No, and that's why they're called dynamic asset allocation also, because
they
the fund
fall
manager
into our
has
category, where he has the flexibility of moving more into equity or less into debt, or more into debt and fixed or less into equity, depending on the circumstances. So he's basically taking a call on that, on the an allocation based on the outlook of the various component of the market. I have my doubt about a fund manager's continued ability to perfectly time his allocation to a certain thing, to a certain asset class, because it requires making a judgment about equity is unlikely to do well in recent future, and that is why I should reduce it. And there is no evidence that many funds are able to do it consistently. Sometimes they do it, but they don't do it often, or they don't do it consistently. But I have great belief in a disciplined strategy, and a disciplined allocation itself creates a great deal of opportunity and alpha for you. Now, multi-asset funds is a third category where it is not only having equity and debt but also precious metal or commodity. And because gold has done very well and it has become a fairly mainstream category, and it has been able to provide reasonable return or decent return with great stability in the last 5-7 years. And that is how this multi-asset category came to life or came into being.
All right, so that's the basic definition of the three of them. All right, when it comes to diversification and risk management, which of these hybrids scores better than the rest?
They're somewhat similar, but I would look at it in terms of hierarchy. The aggressive hybrid funds, which is 75% equity, 25% debt, they are meant for investors who are first-time investor, or they are not very comfortable with the big swings of the equity market. Right. So I like it for its simplicity. It gets you great diversification. It gets you the fixed income allocation. It gets you rebalancing, and it could be a long-term vehicle. And you are not deprived of any great opportunity by investing in a relatively stable fund, which does not scare you out of the market when going gets tough. So that is one. It should be looked upon as a quasi-equity fund, a vehicle, or a relatively steadier equity vehicle. When the balanced advantage fund is something where they're old. They have been around for a while, but still, I would say that it is heavily dependent on the fund manager taking a call and being right as well. Just taking a call is not good enough, because he has to be right, and sometimes it could be a little disappointing. But I would look at it as a relatively steadier vehicle because of its very design. It tends to be not 75% into equity mostly, and that is why I would think that you want an even more stable vehicle, go for it. Multi-asset fund. That is something which still has to shape up, but and it is heavily dependent on gold performance and gold allocation to gold. Have your fixed income allocation, have your equity allocation, have a little bit of gold, but not through multi-asset, simply because you will be frozen into it.
Okay.
You will not have the flexibility of deciding on your own.
Right. Now, a lot of people want to know, how are each one of them taxed?
Equity aggressive is taxed as an equity fund. So long-term gains are taxed at 10%, short-term gains is at 15%. Simple. They are treated like equity fund. Balanced advantage depends on the asset allocation. And generally the endeavor of a balanced advantage fund is to get treated like an equity fund, because that is how they came into being.
Right.
So mostly balanced advantage funds are treated as equity fund. Multi-asset funds depends. If the fund has chosen, and it depends on the average asset allocation, average allocation to equity through the year. If it is more than 65%, then it is treated as equity, else fixed income. Things are pretty straightforward. Equity or debt, and depending on the allocation, and mostly balanced advantage and definitely aggressive hybrid funds are treated as equity.
Okay. Now, the most important question: under such circumstances, when the markets are volatile, which fund is most suitable for investors to invest in?
For somebody who understands and appreciates the risk of equity market and still want to start, he should start with aggressive hybrid fund. If you have some sizable money and you want to invest, and many a times people accumulate their savings in their account and then they want to invest 4-5 lakh rupees, that's the mindset. For them, balanced advantage, and that is a medium-term investment, balanced advantage could be a vehicle. So it entirely depends on your risk tolerance, on how comfortable you are, because there are many people who are fine with 50% decline, and they are able to stick around and they are able to see through it. For them, a flexi-cap fund is good enough. But for somebody who is little fearful, gets upset, then aggressive hybrid fund, medium-term investment, and little fearful, balanced advantage. I think these two funds actually fulfill the need of most investors' aspiration.
All right, hope that clears all your doubts about hybrid funds. Now, a viewer has sent in a question. Preeti Kadam says she's got 3 crore rupees of insurance money after her husband. She wants to invest that money in flexi-cap, mid-caps, and small-cap funds. So is it okay to park that money in liquid funds and do an STP from there? Or should she park this money in a balanced advantage fund and plan a systematic withdrawal from there?
I would say that she needs a slightly more complicated plan. She should estimate what is her monthly requirement, and whatever she needs in the next 3 years every month. Say you need a lakh of rupees every month, then that means 35 lakh rupees, 36 lakh rupees. Put that into liquid fund. You are taken care of, sorted for next 3 years. Every month you will keep getting your 1 lakh rupee. Rest of the money, put it in a short-term debt fund or an ultra short-term debt fund, dividing that money over the next 36 months to a flexi-cap fund. And maybe 2 to 3 flexi-cap fund. Over the next 3 years, this is the longest time period over which you should invest in equity. And that is how you will eliminate the possibility of catching a market high. You will not get upset. And once you keep doing it, after 3 years, you will get an opportunity. Many of your equity funds, equity investments will be more than 1 year old. And then you have to see that how much is the deficit, how much money you need over the next 1 year. And depending on the appreciation that you have witnessed, you can revise your withdrawal rate.
All right, Preeti, hope that answers your query. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.